Obviously, a couple weeks ago, we talked about President Biden's tax plan, the impact on C corporations. Today, we're going to focus more on the impact on individuals. So I think this is pretty applicable to everybody here in the office, but also a lot of our clients and people that we do business with. So we're going to kind of talk about some of the provisions in here, what to expect, why we're having this conversation, and some of the changes to 1031, proposed changes to 1031 exchanges, and the impact that that would have on estate and gift taxation, and all that kind of plays into a common tax strategy that a lot of our clients employ from a real estate perspective. So we kind of hit on this a few weeks ago, but why are we having this conversation? You can see on the left, this is our total US public debt. You can see now in 2020, it was, I think, $27 trillion. 2009, it was 11. So we've really increased our overall national debt. But then on the right side, this is corporate and US individual tax receipts from the US government. And so you see in 2006, individual income taxes, where that was and kind of where we're at now in 2019 at the bottom. So that's kind of gone up like you would expect. On the corporate side, our corporate tax collection is way down. I mean, it's 2/3 of what it was 15 years ago. And so that plays into kind of why we're feeling this pinch as a country. We have this debt and we have, decreasing tax revenue from a corporate side of things. And on the individual side, one thing that's a little bit different about the US compared to other countries is our reliance on income taxes. So you see the OECD average overall for those countries of their national budget, their total receipts, 24% is individual income taxes. For the United States, it's 41.5%. And that's because other countries have consumption taxes, VAT taxes that's applied to each good and service as it's produced and rendered. And so on the right side, you see this chart compares the United States on the far right in dark green, our VAT or sales tax rates, 7.5% on average. You compare that to a lot of these other countries and they're collecting a lot of money different ways, right? And so because our VAT tax isn't as high, or our sales tax, said differently, is not as high as other countries, we kind of feel this pinch and we're more reliant on income taxes and how that impacts our national debt. That's why we're kind of having this conversation. So one of the big changes that President Biden proposes is in a lot of this, on a lot of these topics, is 2.5 years ago, President Trump signed into action the Tax Cuts and Jobs Act of 2017. And so what that did was, on the individual side, it reduced the highest marginal U.S. income tax rate from 39.6% to 37%. President Biden's plan for this is to go back to the pre-Tax Cuts and Jobs Act level. So to increase the rate, 2.6% on the highest earners in our country. In 2021, that rate kicks in for individuals who make over $523,000 or $628,000 if married filing jointly. Tax Policy Center, which is a nonprofit think tank, says that would raise $111 billion over the next 10 years. Here's a chart kind of showing where the top U.S. marginal rates have been for the top 1%, the top 100% earners as well over the last 100 years or so. So you see in the 1980s, we had the big tax cuts that dropped the top rates down from over 50% down to a little bit south of 40. And honestly, we've kind of stayed pretty consistent with that between 30 and 40% for the last 40 years. And you see where we're at right now on the right side. And then you see where the rate would be in 2022 if Biden's plan were passed. So pretty large increase, closer to 40% for the top 100th%, but also the top 1%. And these are just marginal tax rates, right? These aren't overall tax rates. These are on every dollar earned over a certain threshold would be taxed at a certain way. It also doesn't include things like capital gains, estate taxes, et cetera. In regards to capital gains, this has been a hot button topic. The current long-term capital gains, so you buy an asset, you hold it for 1 year or more, a capital asset, hold it for 1 year or more, it's taxed at a lower rate, 20% plus the 3.8% Medicare surtax under Obamacare. And so short-term capital gains that are currently taxed at ordinary income rates. If you own an asset for 1 year or less, you don't get the preferential treatment. Under Biden's plan, individuals who earn over $1 million would pay ordinary income tax rates on long-term capital gains and ordinary gains, which is the current rule. So that means the highest capital gain tax rate would be 43.4%. So if you make over $1 million, you have a capital gain, long-term or short-term, it would be taxed at 43.4%. That's the 39.6 plus the Obamacare surcharge tax. So this would apply, according to a couple of different organizations, they're projecting this would apply to 1/3 of 1% of households in America. So the projected impacts would be on about 500,000 households in the country. And then in comparison to C corporations, which we talked about a few weeks ago, they already pay ordinary income tax rates on capital gain income, whether it's short-term or long-term, it's still taxed at that ordinary rate. And if the rate goes up on the corporate side, most people expect that, that rule would continue to follow it. So if we went from 21 to 28 or 21 to 25, C corporations would still pay ordinary income tax rates. There wouldn't be a beneficial rate to them. So, the big change within the long-term capital gains under Biden's plan is that long-term gains would be taxed at ordinary income rate for people who earn over $1 million. So here's a chart I put together that shows on the left side under current law, kind of where we're at. So the three rate brackets for capital gains are 0% for long-term capital gains. You hold something 1 year or longer, 0%, 15%, 20%, 20% kicks in if you are a high earner over 440,000, if you're single, 500,000 or more if you're married. And then on the right side, this is President Biden's projected plan. And honestly, this kind of brings up how early on we are into this process. Like a lot of the proposed things don't have a lot of meat behind them. They don't have a lot of details. So I just left some of these numbers the same in terms of when it would kick in. This is all guesswork on my part because there's nothing to work off of. So you see under Biden's plan, there'd be four rates, 0, 15, 20, but then this 39.6, which is really 43.4 once you factor in the Obama medical surtax there on capital gains. So if you earn over $1 million or more, you'd be taxed at this high rate. So we've kind of talked about the rate side on the deduction modifications. So President Trump's plan really focused more on modifying what counted as income and what counted as deductions and what you could deduct in some ways than that overall rate changes. And I feel like President Biden's plan is the opposite. It focuses more on the rates and less on deduction modifications for individuals. One thing to watch though, and this is kind of going to be the hot button topic, is the state and local income tax deduction. So President Trump's plan, the Tax Cuts and Jobs Act, put a cap on the amount of state and local taxes that individuals could deduct on their federal tax return. So on your US tax return, you can typically deduct any state taxes that you pay. And that constitutes property taxes, income taxes, sales taxes, et cetera, et cetera. And so previously there wasn't a cap. And so what President Trump's plan did is it limited it to $10,000. So if you live in New York and you pay 10% in state taxes, and you make $1 million, all of a sudden your deduction is being limited. There's a cap on it. And so what's happened over the course of a few years is this has played out, and this plays right into population growth changes, migration from the Northeast, from California to Texas and places like Florida as well, is people are seeking, it makes low tax states even more attractive. When you can't deduct the amount of state taxes that you pay on your federal tax return, then what's the benefit of living there, right? From a tax perspective. So this is going to be a major sticking point though, because as gridlocked as the Senate is and will be on tax reform, a lot of representatives, both senators and representatives in the House from these states, Republican and Democrats, have stepped up and spoken out on this issue and said, because of the population shift that we're seeing, people leaving our states, we need to get rid of this limitation. We need to keep people in our state and not give them another reason to leave. So the real question is going to be, will moderate Democrats from those areas, and there are a few senators, not support President Biden's plan because it hurts their state, or will they go along with party lines and continue to support this plan? It's one of those things where Democrats, from just a pure policy standpoint, would be supportive of reduce deductions for high earners, right? That's consistent with a lot of what we're seeing within this policy, within this plan from President Biden. And so this is really going to be the sticking point. If this thing blows up, it could be because over this issue, people won't either President Biden refuses to budge on this, or Democratic senators from these states refuse to support President Biden's plan without an adjustment to this. And so it's really going to be fascinating to watch, because typically, again, those Democratic senators from those states would probably be supportive of this bill if it wasn't their state, right? If it wasn't impacting their population, their citizens that they're representing. So again, this is going to be really fascinating to watch. Section 199 Cap A, this is another thing that was in President Trump's plan. And so when we reduced the corporate rate from 35 to 21, this was supposed to be kind of the offset for partnerships, flow-through entities, self-employed people. So it's a 20% deduction for owners of flow-through businesses. So everybody in our room watching this, if you've done your taxes right, you've probably benefited from this, and you probably get a 20% deduction on your individual tax return if you go look at it, or on your business return as it flows through, right? And so President Biden's plan keeps this in place, but it puts a little bit of a harder cap on it. So currently, if you earn over $326,000 married filing jointly, it's phased out. It doesn't mean it's eliminated, but it's reduced as your income goes up. This was also set to expire at the end of 2025. A lot of these Trump tax cuts, Trump plan, a lot of his tax plan had a sunset provision at 2025. And so either way, whether we put in a new tax plan or we had a vote to extend a lot of those deductions, some of these things were going to be on the chopping block, or at least getting reviewed in terms of their impact over the last 5 years. So again, President Biden's plan would keep this, but it would really put a little bit of a firmer cap on it. Most people have said it's probably going to be around $400,000, that if you earn over $400,000 married filing jointly, that it's fully phased out and you wouldn't benefit. But again, there's not much guidance out about what he wants to do on this, but something to watch, because that does impact a lot of us, a lot of people who have flow through income, things like that. One thing that the President Biden's plan brings back, which might impact some of you and some of your clients who sell to a lot of first-time home buyers, a lot of your home developers, is there's a first-time home buyers credit, a tax credit equal to 10% of the purchase price, $15,000 maximum. There's certain rules on the value of the house, on the amount of income that the participants earn in comparison to the median income. Again, this is all very first draft. There's not a lot of how you would measure this in comparison to the area, whether it's county or city or zip code. So stay tuned on that. But again, this hasn't passed, but it's been proposed. In 2008, when we were feeling the impacts of the recession, a similar bill was passed to try to stimulate growth, and over 1.5 million home buyers took advantage of the program. Are we in a similar place to there? I don't think so, in terms of needing to incentivize people to go out and buy houses. It seems like there's a lot of demand. In some ways, demand exceeds supply right now, as a lot of you know. So we'll see. I don't necessarily expect this to get passed as part of it, but it's being discussed. So one of the other huge areas of change is within the estate and gift tax area. So the biggest change is that President Biden, his plan calls for a major reduction in the estate tax exemption. Currently, if you pass away, if you're a married couple, you could gift up to $22 million tax-free from estate taxes to your heirs. And so, and you can see that by year where we were on the estate tax. So in 97, we were at 600,000, 2009, 3.5 million. And then, from 2017 to 2018, one of President Trump's provisions in the Tax Cuts and Jobs Act was doubling the estate tax exemption. So now it's in 2021, it's 11.7 million. And again, this is another thing that sunsets in 2025. The exemption was automatically going to drop back down to 5 million unless they did something. President Biden's first draft of his plan would accelerate this sunsetting provision, and he would reduce the estate tax exemption to the 2009 amount of 3.5 million per person, 7 million per couple. So if you were married couple, you could gift, up to $7 million of an estate to your heirs tax-free. So that's one part of it, is dropping that number back down to kind of where we were a decade ago. The second part of this is, and this impacts a lot of our clients, is removing the step up in basis at death. So typically when you die and you gift you die and your estate has properties, right? Your heirs who receive those properties receive a step up in basis, their tax basis, to fair market value on the date of your death. So if you bought a property for $100,000 and it's worth $1 million when you die, there's typically, if you sold it, you'd pay $900,000, in gain. You'd have a $900,000 gain that you owe taxes on. Well, when you die, your heirs receive that property at a stepped up basis at death to $1 million. And so that's why we see a lot of clients who 1031 exchange all the way till they die, because then taxes are never paid, right? You're deferring taxes, deferring. And then when you die, your heirs receive a step up in basis and they could sell it immediately after. And in theory, they'd sell it close to the fair market value, which would be based on an appraisal, and no taxes would ever be paid on those gains. And so one thing that President Biden's plan calls for is a removal of the step up in basis. So current plan is if you had gains in excess of 1 million or 2.5 million per couple, once you factor in a real estate exemption, those gains would be taxed at death at the capital gain tax rates. So here's another provision that would impact this right here, is what we talked about earlier about the new capital gain tax rates. So all of a sudden, if you make over $1 million in a given year, and your parents die and you receive property that is appreciated, and you have a huge gain on that property, you could pay 43.4% taxes on that, in addition to estate taxes, if the estate value is high enough. So all this stuff is interconnected, which I'm going to kind of go into in a second after this slide. So Section 1031 exchanges, we've talked a lot about this. President Biden's plan would eliminate 1031 exchanges on real estate profits of over $500,000. So 12% of commercial real estate transactions involve 1031 exchanges. 84% of those are done by sole proprietorships, which is interesting. Only 16% done by C corps. So Section 1031, and Gary mentioned this last week, was passed in 1921. I think a lot of people would be surprised if this gets repealed. The interplay between this and the step up in basis makes me think it might be one or the other. I mean, if you're repealing the step up in basis at death, some ways that takes care of the ultimate tax on 1031. So there's not really a reason to get rid of 1031 exchanges. So some of this is kind of connected a little bit, and, I'll get into this at the end, but we have a long way to go on this. Personally, I don't think this is going to get changed, but we'll see. But, following up on Richard's email that he sent out, if you have, congressmen or people that you can get in touch to give real world examples of how this has benefited your clients, benefited our business. I know it has in a lot of ways. That stuff's important. I think NAR and a lot of organizations are going to be already targeting some of these moderate Democratic, senators about this issue, because this is something that doesn't need to be changed. And we'll talk about at the end, the overall impact of this is very minimal in terms of increased revenue for the government. It's $7.5 billion, which sounds like a lot, but in comparison to some of these other items, this is a very, very small number. So again, I think if they're going to cut things, things that are small out of this plan, the smaller numbers are easier to kind of keep in place. So I feel a little bit better about the 1031 situation than I think has been portrayed a lot in the media lately. So again, this is kind of what I was talking about. Section 1031, the estate tax exemption, the step up in basis at death, and the capital gain tax rate are all connected, right? Like I was saying, a lot of our clients do 1031 exchanges on properties during their lifetime. They keep deferring the tax, right? Which is a basic tax strategy. 1031 from property to property, you never pay taxes on that gain if you hold those properties until you die. And then your heirs receive a step up in basis at death under the current law. Well, when you die, obviously you have to pay estate taxes. The current exemption, again, is $11 million if you're single, $22 million if you're married filing jointly. Your heirs wouldn't pay taxes on the estate tax, the overall value of the estate. Well, President Biden, on the left side there, as I mentioned, he's proposing to eliminate 1031 exchanges over $500,000. And then he's also proposing to reduce the estate tax exemption to $3.5 million or $7 million if you're married. So, that plays into typically, like I said, is in our current kind of basic tax strategy of deferring via 1031 and estate taxes and step up in basis to fair market value at death. The heirs receive that property at a higher value. Well, under President Biden's plan, that wouldn't happen either. So no step up in basis, again, if the gain's over 1 million or 2.5 million if married. But also the heirs, when they receive, that appreciated property, have to pay capital gains tax on it under this current plan. And so that is also impacted by the highest capital gain tax rate if you earn over $1 million, right, that we talked about earlier. So all this stuff is somewhat connected. So it'll be interesting to see how basic, real estate tax deferral strategy is impacted by what actually gets passed, if anything. I wouldn't expect all of these provisions to get passed in their current form, or really any of them in their current form. I think there's a long way to go. But will there be some impacts to this strategy? Yes. And I think it's important that we get our clients, thinking along those lines and get them in touch with their real estate, their tax, consultants and tax providers, and kind of get them thinking, okay, what's the best decision I can make for my family long-term in terms of estate value, but also, current and future tax deferral strategies, and should we try to push to get a deal done by the end of the year? One other thing that President Biden's plan is proposed to do is to increase the IRS budget. So he wants to increase the IRS budget by $80 billion over the next decade. On the right, you can see what's happened to the overall IRS budget and the number of revenue officers and agents as well. So it's really, the IRS has taken a lot of hits over the years, and because of that, they're very thin in terms of getting answers on stuff. And if you get audited, in public accounting, we had some clients that had 15 years worth of open IRS audits because we couldn't get stuff done. And so the Joint Committee and a number of these, both Republican and Democratic tax think tanks, have projected that the return on this on these dollars is 4 times. So from a government spending perspective, I think Republicans and Democrats could get behind this, right? What other thing that the government spends money on brings in $4 per every $1 spent? I don't think there's anything. So, it's projected to raise over $300 billion of new taxable money over the next 10 years. And Joint Committee and a number of these groups actually think that number, that 4 times multiplier, is actually pretty conservative. So we'll see. But this is also
Hey, Tyler, I got a question. What would cause that 4-to-1 ratio? Is that just people taking deductions that aren't actual deductions? They're cutting down on that, or is it?
Yeah. So it's basically that there's more IRS that give the IRS more ability to hire more staff and more revenue agents and officers to actually pursue people who are dodging taxes, and give them more firepower to actually go after certain people and certain groups who are doing certain things. Because right now the IRS, when they figure out who they want to audit, it's all analytics based model, and that factors into that, I'm assuming, is their overall ability from a staff perspective and time and capacity perspective on how much they can actually audit each year. And so I think that factors into it a little bit, but again, it's mostly just their ability to go after groups and go after people who are, because a lot of these big transactions, it's not like they're auditing you or me. If they're auditing X, Y, and Z corporation or whoever, those are years worth of court cases sometimes, and it's a lot of dollars that have to be spent to pursue some of that. And so it's just one thing to kind of keep in mind. But again, most of these groups that are a lot smarter than me on both sides of the aisle think that number is actually pretty low. So this seems to be the one thing that kind of both parties are behind a little bit. So we'll see. Again, some of these models that I've talked about, the Tax Foundation, I mentioned them 2 weeks ago. Over 10 years, their impact of eliminating 1031 exchanges would raise $7.5 billion, in comparison to the impact of raising the top individual tax rate, which would raise $116 billion. The 1031 impact's pretty small. So again, I think that's a positive in terms of being able to argue to keep 1031s in place. tax on unrealized gains at death would raise $183 billion. Another big group, the University of Pennsylvania Wharton model, shout out to Larry Montanus. The Biden plan would raise between 3.1 and 3.7 trillion in additional revenue over a 10-year period. They say that 54% of the increase in revenue would fall on the top 0.1%. After-tax incomes would change by 18% for the top 0.1%, 9% for the top 1%, and by less than 1% for all groups outside the top 5% of income distribution. They predict a reduction in GDP of 0.6% in 2030 in comparison to kind of the current baseline of where we're trending. So a lot of their stuff is comparing, reducing federal deficit, which can increase, federal government investment and expenditures, but increasing tax rates discourages labor and savings. So kind of the interplay between all of that, not even from a political standpoint, but just from a numbers perspective is really interesting. And again, groups a lot smarter than me are the ones running these models and these predictions. So their prediction is by 2050, if the plan were passed, government debt would decrease by 6.4%. But again, the impact to GDP is a negative. I mean, job growth would be a negative compared to current baseline spending. And also wages would go down in comparison to normal baselines. So it's all kind of a give and a take. So does anybody have any questions?
Is there any talk about reducing spending?
Depends on what bill you read. If you read the 16-page document, it's all about spending. So I don't know. I think we need to in some ways. I think it's a combination of both things. I think it's a combination of we need to figure out how to get more revenue just from a budgetary perspective, and also how we cut spending to try to get a little bit more balanced.
I kind of knew the answer to the question.
On the increase in capital gains over $1 million, would that be earnings, or would the capital gains be included in that? I sell the family farm.
Typically the gains included in that. So that'd probably be based on AGI, which is after you would factor in any gain that you would have.
Okay.
But again, Jeff, honestly, some of this there's not much guidance out there, and a lot of it's just big buzzwords and stuff to kind of get people talking on both sides of the political spectrum. So there's not a lot of meat behind some of this yet, and so but I would think just the way that most rates are done is based on AGI, which is the number right before you apply the rate to it. Anybody else?